We are all feeling the sting of higher gas prices, but when energy companies announced record profits for 2022, had a lot of people asking questions about what's behind the price hikes. Is it inflation? Is it the war in Ukraine? Or the drive for higher profits? We are joined this morning by economist Jeff Rubin, taking a look at that with us. Jeff, good to have you with us. Shell saw a $40 billion profit in 2022. That is double its profit from the year before, and the most money the company has ever made in its 115 years of business. I know that's the most dramatic example, but a lot of energy companies saw record profits last year. BP had a profit of more than $27 billion, Exxon $55 billion, Chevron also had a record-breaking year for profit. What's behind this?
Well, as concerned as we might be with the obscene amounts of earnings that these oil companies are racking up, we should perhaps be even more concerned about what they're doing with those record profits, or more precisely, what they're not doing. In the past, they would have plowed those earnings into capital expenditures to develop new reserves, to bring on new supply, which in turn would moderate oil prices over the cycle. They're not doing that anymore. Instead, they're turning themselves into effectively instant teller machines through huge share buybacks and dividend hikes for the benefit of their shareholders. And the difference lies in who owns those firms today. Today, they're owned by different people than in the past. Today, they're owned by retail investors, not institutional investors. And retail investors don't really care about reinvesting in new supply. They just want to get paid now. Institutional investors who used to own these companies largely have fled the sector because increasingly ESG conscious institutional investors have vacated the oil and gas and coal space. I mean, even in Canada, the second largest fund, the Caisse de dépôt, has divested from all of its oil sand stocks, and their vacancy has been replaced by legions of retail investors who just want to be paid now.
Well, I think consumers feel like, well, I want some of that money back as well then. So in the EU and the UK, energy companies are getting taxed on those surplus profits, with the proceeds then going to cover the cost for citizens. Could we see something like that here?
Yes, we could. President Biden, for example, has recommended quadrupling the tax on share buybacks, which will certainly get people's attention. But don't forget that it's the retail investor who's demanding those share buybacks. Redistributing the earnings are fine, and certainly a case can be said that consumers should benefit to some extent, but it won't redress the bottom line problem. The bottom line problem is a lack of supply. And what's causing that are two basic reasons: this lack of capital spending in the industry itself, and the sanctions against a country that exports 8 million barrels a day that have totally backfired on Western consumers.
So should we expect gas prices are high for the foreseeable future?
I think that that is a reasonable assumption. We may tax oil companies and distribute those earnings, but we're not really redressing the reason why oil prices are so high. And let's not lose sight of the fact that it took a lockdown of the largest oil importing economy in the world, China, and the largest withdrawals from the Strategic Petroleum Reserve to get oil prices down to $80 a barrel. They're probably going to head back up to triple-digit range, and these companies like Chevron and BP will even earn more. So again, we really need to address the supply problem, and the supply problem is that oil companies are not investing in new capacity, and the sanctions have basically backfired against Western consumers because, yes, Russia's been forced to sell at a discount to places like India and China, but the world prices from which that discount is based has soared. Brent got up to $128 a barrel. So the net effect is we're enriching the country we're trying to impoverish. Wow. Russia's oil and gas exports were at an all-time high. China and India get to buy oil at a discounted price,
Right.
and Western consumers are scrambling to make up the shortfall by paying premium oil prices. Maybe it's time for a new plan.
Or maybe it's time to get an electric car. Jeff Rubin, thanks
Or
so
maybe
much.
it's time to get an electric car. But the problem is that world oil demand keeps on increasing. And this year it's going to be about 101.7 million barrels. Where's the supply to meet that demand? Well, the kind of prices we're seeing is the result of that mismatch.
Jeff Rubin, thanks so much.
My pleasure. Take care.
Just on a note for this interview, we did reach out to Shell for a statement. We did not hear back in time for this interview.
Hey, thanks for watching. If you liked this, be sure to subscribe here, or you can check out more Your Morning videos right here.